Welcome back to the Deep Dive. Today, we're digging into the New York Times company, specifically their Q3 2025 performance. This is a report a lot of people were watching, and frankly, they delivered. I mean, the big takeaway. That strategic pivot they've been talking about for years, it's not just talk anymore, it's really working and actually accelerating. These results, they basically confirmed that the bet on high-value subs and, diversifying the products, it's paying off. Big time. Scale, profit, leverage, it's all there.
That accelerating leverage, yeah, that's exactly what got the market buzzing. If you just look at the headline numbers, I mean, they crushed consensus, both top and bottom line. Non-GAAP EPS came in at 59 cents. The street was looking for, 64 cents?
Right, a solid beat there.
Definitely. And total revenue hit $700.8 million. Again, ahead of the $692 million expected. That's 9.5% growth year over year. Pretty robust. But for me, the real story, the proof of that scaling model is in the profit. Adjusted operating profit AOP, it surged 26.1% year over year, $131.4 million.
Okay, hold on. Let's pause there. Profit up over 26% when revenue's up 9.5%. I mean, that's basically the textbook definition of scaling a digital business effectively.
Exactly right. It pushed the AOP margin up 240 basis points. They landed at 18.7%. And think about why. The cost to add that next game or article view for an existing subscriber, it's almost zero. So every new subscription dollar, especially from price increases, becomes super profitable. Pure structural leverage.
And you don't get that leverage without feeding the machine, right? The subscriber growth needs to be there.
Absolutely. And it was. Net adds, 460,000 digital-only subscribers just in Q3. That brings the total digital-only count to 11.76 million.
Wow.
Yeah. And if you add print, they're sitting on 12.33 million total subscribers. They're really marching towards that next big goal, that 15 million subscriber mark.
Okay, so let's unpack the subscriber side a bit more because, in digital media, just having a big number doesn't always mean much if you can't monetize it. What I want to know is, are they actually turning those maybe low-cost trial users into valuable long-term customers?
They are. That's the key takeaway here, I think. The average revenue per user ARPU for digital-only subs, it grew 3.6% year over year. It's now $9.79.
Almost $10.
Right. And management was really clear. This wasn't just accidental. It came specifically from moving promotional subscribers up to higher prices. And importantly, raising prices on some of their longtime tenured subscribers.
Okay, raising prices on loyal customers. That sounds risky. Did they talk about churn? Or are they just banking on the brand?
Well, they're banking on the bundle. The whole flywheel strategy hinges on this. The idea is you bundle news with games, cooking, The Athletic. You make it so useful, so integrated into daily life that people just won't drop it, even with a price hike. The value proposition of the whole package becomes much higher. So yeah, the fact they could raise prices and ARPU still went up, it validates that perceived value is north of $9.79.
That makes intuitive sense. Right. You might ditch just the news if money's tight, but maybe not the news, plus your cooking app, plus the crossword you do every morning. And that strength drove digital-only subscription revenue up, what was it, 14%?
Yep, 14% to $367 million. Huge driver. And we're seeing hints of this multi-product appeal elsewhere too, like the family plan.
Right, that's relatively new.
Yeah, it's priced higher, so it's definitely adding to revenue. Still small, maybe 2% of the digital base, but it's growing. It just shows people are willing to pay a bit more for that convenience and the wider access across the different products.
Okay, so subscriptions look really solid, engines firing. But let's pivot to the other side of the coin, advertising. That's been the weak spot for so many legacy media companies trying to go digital. How do they do?
Surprisingly strong, actually. That was one of the bigger positive surprises. Digital ad revenue jumped 20.3%. That's huge, $98.1 million.
Wow, okay.
Total advertising, including print, was up almost 12% to $132 million. That blew past what they thought they'd do. It really signals they're making progress building a more, let's say, durable digital ad business, not just relying on basic display ads.
Wow. What's driving that strength?
Well, they point to building this business across the whole portfolio: sports, games, shopping, news. It's not just about the front page anymore. And they're leaning heavily on their own first-party data, which is gold these days. Plus, this AI-powered ad product they call Brand Match.
Brand Match.
Yeah.
What does that actually do? Why is that better than, standard ad tech?
Because it gets around the whole third-party cookie crumbling issue. Essentially, it's their own AI system. It matches advertisers directly with specific content themes and audiences based on the data they own, the Times' own data.
Ah, direct connection.
Exactly. So if you sell, say, fancy kitchen gear, Brand Match connects you right to the cooking app users. Better targeting, higher engagement for the advertiser, more premium pricing for the Times. It shifts them away from relying on those volatile, low-value general display ads.
That is a smart move. A real differentiator. Okay, so top line looks good, both subs and ads. But what about costs? For that margin expansion story to hold, they need discipline there too.
They do, and they showed it, mostly. Adjusted operating costs were up 6.2%. That was actually a tiny bit higher than their previous guidance, which was 5-6%.
Okay.
But management didn't frame it as costs getting away from them. They called it disciplined investment. They're specifically putting money into things that fuel that flywheel journalism, obviously, product development, and smart marketing. Like it's your role to understand campaign we've all seen.
So spending to grow, not just spending to keep the lights on.
That's the idea. It's strategic spending.
And underpinning all this, the cash flow situation, how healthy are they financially?
Extremely healthy. Free cash flow generation is a major strength. Get this. Nearly $393 million in free cash flow just in the first 9 months of the year.
That's a lot of cash.
It tells you the operation is efficient, and it means they can easily fund their capital return promises. They sent $191 million back to shareholders in those 9 months, about $110 million in buybacks, $81 million in dividends. And they reiterated that plan to return at least 50% of free cash flow. Very shareholder friendly.
Okay, let's shift focus a bit to the future, the long-term moat they're building. They talked a lot on the call about product innovation, which seems crucial if they want people to keep paying that nearly $10 ARPU, or maybe even more. Video seemed like a big push.
Oh, absolutely. They're making a serious play in video journalism, taking their big hit podcasts, the award winners, and turning them into full video shows. That's significant. Plus, they're adding a dedicated watch tab right in the main news app.
Integrating it deeply.
Exactly. And over at The Athletic, they're adding things like NFL game footage to enhance the analysis. They already do this with the NBA. It just broadens the value perception. It's not just text anymore.
And AI. It sounds like it's moving beyond just back office efficiency and becoming more customer facing.
That's what's interesting. Yeah, I mean, sure, they use it for personalization, ad targeting, the usual stuff, but they're also building it into features that directly help the user, justifying that subscription cost. Like AI automatically converting metric measurements in cooking recipes or powering better search results on Wirecutter.
Little things that add up.
Exactly. Small utility features that make the bundle stickier day to day. Oh, and they mentioned content R&D too. They launched a new logic puzzle, PIPS.
PIPS.
Seems minor, maybe, but it shows they're constantly feeding the games part of the bundle with low-cost, high-retention stuff. Keep it fresh without breaking the bank.
Right, constant value add. Now, it wasn't all sunshine and roses. We should touch on the risks they flagged. They specifically mentioned AI-related litigation costs.
They did, but they were careful to call those out as special items, basically telling analysts, look, these are one-off costs related to defending our IP. Don't bake them into your core operating models. It keeps the focus on the underlying business profitability.
Got it. Non-recurring.
Right. And we should also probably mention the guidance for that affiliate licensing and other revenue line. It showed a bit of a slowdown for Q4. Expected growth is mid-single digits.
So slower growth there.
Marginally slower in Q4, yeah. But management still expects that line item to grow long term. They argue their IP is just becoming more valuable over time, especially for licensing deals.
Okay, that makes sense.
Yeah.
So that brings us to the overall outlook. The Q4 guidance. It sounds like it basically reinforced the bullish story.
It really did. The momentum seems set to continue. They're guiding for digital-only subscription revenue growth of 13% to 16% in Q4.
Still very strong.
Very. And digital ad revenue, expected to grow mid to high teens, again, really robust.
So even if print continues its slow fade, the digital side is more than picking up the slack.
That's the picture, yeah. It puts them in a really strong position compared to others in the media space. When you zoom out, look at the whole industry. Everyone's trying to figure out the shift from ads to paid subs. The Times, with its strong brand, its successful bundle, its first-party data, they're way ahead of peers, still stuck relying on volatile display ads.
So the strategy is working in the current environment.
Perfectly suited for it, arguably. And new term, you've got catalysts like more price step-ups, a seasonally strong Q4. Analysts expect this to push the stock towards its highs.
Okay, powerful story. Which brings us inevitably to our segment, This is not financial advice. Just a reminder, we're not telling you what to do with your money. We're just exploring how a professional investor might think about these results structurally. This isn't about quick trades. It's about the long view.
Okay, so the thesis here is pretty straightforward. The market still isn't fully appreciating the compounding power of that ARPU growth. We've talked about it. It's driven by smart price increases and that sticky bundle. This isn't just about ads coming back. It's a fundamental margin improvement story. That 18.7% AOP margin, we think that's repeatable, maybe even beatable, because the value's there and the cost to serve each extra user is low.
Right. So what's the outrageous but plausible pitch? The trade idea.
Okay, here it is. Long NYT. The bet is that the AOP margin continues to expand, maybe significantly beyond 18.7% over the next, say, 12 to 18 months as that ARPU compounds. Now, to make it a classic hedge fund style paired trade, you'd look to hedge that long how? By shorting a digital media competitor.
Which kind?
One that's still heavily reliant on those shaky display ad revenues, and crucially, one that hasn't managed to build a successful high ARPU multi-product subscription bundle like the Times has. So essentially, the trade is betting on the Times' premium IP and pricing power against a company still stuck chasing ad cycles. Value versus volatility.
That is a clear structural argument. Okay, let's recap the whole quarter then. Q3 2025 for the New York Times really felt like textbook strategy execution. You saw the accelerating digital growth, clear margin expansion, that core subscription strategy, the bundle, the flywheel. It's working. It's propelling them toward that 15 million subscriber target, and importantly, with more money from each user.
Absolutely. Which leads to maybe a final thought for you, the listener, to chew on. We see them successfully integrating The Athletic, games, cooking.
Yeah.
We see they have pricing power, pushing ARPU towards $10. The question is, how much higher can that digital ARPU realistically go before consumers balk? Is maybe $12 the next stop for the full bundle? And if it is, when does the market start pricing that possibility in?
Something to definitely think about as you do your own research. That wraps up our deep dive into the New York Times Q3 2025 performance.